Hello, and welcome to Portfolio Matters, weekly markets checklist, week 210. And Stuart Owen is dining in from Tokyo once again. But before we get going, he will read the disclaimer.
Everything discussed during the Portfolio Matters podcast is for informational purposes only and should not be considered as investment advice. Listeners should be aware that we will be discussing securities that we own or have a financial interest in. Please do your own research or consult a professional investment advisor before making any decisions regarding topics mentioned on the show. A full disclaimer can be found at the end.
Right, thank you, Stuart. We have another packed program this week. So let's start off with the war news. Events over the past couple of weeks are summarized here. I'm not going to go through it all. You know all this. The bottom line is, last Tuesday, Donald Trump was threatening to destroy Iranian civilization in an expletive-filled tweet. And then on Wednesday, he completely turned around and announced a 2-week ceasefire following talks in Pakistan, and the markets took off. And we have seen an absolutely extraordinary rise in equity markets. We will take you through all the data in due course. Since then, the ceasefire has mainly held after a few wobbles, but there appears to be no solution to ending the war, in that the US have announced a blockade of Iranian ships traveling to and from the Straits from Iranian ports, while also stating that they will be clearing the main straits of mines, but there seems to be very little progress on that. So, as of today, Israel has announced a 10-day ceasefire with Lebanon overnight, and Donald Trump has stated that peace talks may resume in 2 days' time, and separately has said that an agreement with Iran is very close, but he's said that before. The tone of Donald Trump's tweets is that this war is proving to be unpopular and he wants out of it. Stuart, your thoughts?
The word that I think we need to focus on is sane washing. We try to ascribe some sort of sanity and strategy to this, but I mean, if the guy wasn't a drinker, you'd say, my God, he's a heavy drinker. The flip-flops, the chaos, the incoherence. I mean, someone showed me a timeline of his tweeting. It's coming out every couple of minutes, and then he's off for an hour or so, and then he's back on. And this is all like through the night. Can you imagine, what's going through his mind? It's just chaos, and I think we shouldn't try to ascribe
Yeah.
strategy to this.
Well, the markets are off to the races. The markets have been absolutely extraordinary. We'll take you through all the data, but precious metals, equities, industrial metals all have had an astonishing 2 weeks. So the markets believe that this war is close to an end, and also it will have very little effect on the world economy. So this is very badly explained by global media, but the US plan is to blockade ships which are traveling from Iranian ports and which Iran has permitted to travel through its waters by paying a toll, etc. And separately, to clear the area that Iran claims to have mined to allow shipping through the main Straits of Hormuz. So far, we have seen very little activity there, I would say. So, we'll take you through the data. Currently, very little traffic is traveling through the Straits.
So, Keith, can we say that the US is blockading the blockade?
It is, yeah. Now, could this be an effective strategy? Well, actually, I think it could, in that the last round of protests in Iran, which the Iranian regime ended by murdering at least 10,000 people, was triggered by deteriorating economic conditions. And this blocks off Iran's main oil exports and puts further pressure on an already weakening economy. So, why didn't they do this in the first place? This could well bring Iran to the negotiating table in a way that bombing them did not. But what would you do if you were Iran? So both sides wish to avoid a return to hot war, I would say. That's certainly the tone of Donald Trump's tweets, and Iran has obviously wishes to avoid being bombed. So if I was Iran, I would be aiming to keep oil prices high, which attacks Donald Trump's main weakness, which is his popularity, and also to try and co-opt my allies, i.e., China, into the conflict. So if I was Iran, I would be aiming to keep the Straits closed for as long as possible. And that means making sure the Straits are well mined and closed, which is sort of passive aggressive rather than actually aggressive. And also attempting to persuade China to get its vessels to run the blockade. If the US is faced with a tanker which has Chinese army personnel on board, are they really going to try and stop it? Question mark. Now, in the case of the US, ultimately, how long can they keep this blockade going for? Currently, the equity markets, etc., are giving them the benefit of the doubt. But if Iran were to keep the straits closed for a long period of time, then the oil price would rise, equity markets would fall, and Trump's already low popularity would fall further. So I don't think the US can keep this strategy going indefinitely. Bottom line is, we appear to be in a siege. The US is laying siege to the Iranian economy, and sieges last a long time unless there is an agreement. But it seems quite easy to end this, as there is no military solution. What is required is a face-saving compromise. Now, the US has demanded that Iran give up nuclear enrichment for 20 years. So the sticking point is Iran's refusal to give up its nuclear program. Well, if they back down and just say they're going to give it up, I suspect that the US will take that as an agreement. So it's a question of face on both sides and how soon Iran decides to back down. That could happen over the weekend. So some charts relating to the news. Well, this is the negotiating positions of both sides. Pause, have a read. The bottom line is they are a very long way apart at the moment. The main sticking point is point 6 of the Iran Revolutionary Guard Council's plan, which is acceptance of Iran's right to nuclear enrichment. The US is not going to accept that. Pause, have a read. So Goldman Sachs estimates that 10.6 million barrels are currently off market, which is the biggest disruption to oil markets ever, but which equity markets seem to be totally ignoring. Not included in the Goldman Sachs numbers, around 700,000 barrels that Iraq is essentially trucking across Syria. So the longer this goes on, the more side channels and workarounds there will be, but at a cost. JP Morgan estimate that global inventories are falling by 6.6 million barrels a day, and we sort of concur with that as the level of disruption. Global crude exports, according to JP Morgan, down 9 million barrels a day, product exports down another 4. So big disruptions to the global economy, you would think, but actually equity markets are off to the races. Now, meanwhile, everyone with an empty tanker is sending it to the US to refill. So that will mean the US will be exporting a record amount of crude in due course, which should mean that the price differential between WTI, the American benchmark, and Brent, the benchmark for the rest of the world, starts to narrow. And this is the number of Iranian-linked vessels transiting the strait. And you can see that after the advent of the blockade, the US blockade, that has collapsed. There has been a small tick up in non-Iranian traffic, but We'll show you in due course that's not big. What's been absolutely astonishing is that given the size of the supply disruption, the rise in the oil price has actually been relatively modest, and the effect on global markets, equities in particular, has been negligible. Thank you very much to Legion 852 for sending this great chart. And none of this obviously is proving popular. So the Democrats now have a 60% odds, according to Polymarket, to win the next presidential election. So in the popularity stakes, Donald Trump is the least popular president since Nixon. It's Nixon's second term, which was characterized by the Watergate scandal. Okay, so where are we now? Let's go through some charts from BCA Research. This is the situation as of yesterday. So, Iranian drone attacks on its neighbors have collapsed. So they appear to be biding the ceasefire after a few wobbles on day one. Their attacks on vessels have also stopped. The amount of oil shut in the Middle East is essentially unchanged. So there's been no increase in Middle Eastern oil production since the ceasefire because they can't get the oil out. Tanker flows through the Straits they haven't increased, but they are up from their lows at the start of the conflict. And the market is not placing very high odds on traffic through the Strait normalizing by the 30th of April. So they don't believe there's going to be a fast deal. Nor do they think that the US escort plan is going to work. And frankly, there's no evidence that the US are actually doing very much. The amount of crude in floatage storage around the world has fallen sharply. But if you look at it in absolute terms, it's not that low. It's now below where we were in the pandemic, but it's well up from norms in to 2017. So part of the reason the equity market seems to be so complacent about the disruptions is that there is still a lot of oil in storage or oil moving around the world. But supply chain pressure is growing, although it remains, again, manageable for now. Time spreads are down from their peak, but still substantial. So the market is expecting the Brent crude price to fall from here, but futures are remain elevated. Diesel prices, these are diesel prices in the US, have shot up. They're down from their peak, but they're still, what's that? Double where they were before the start of the war. So this is affecting US consumers and therefore affecting Trump's popularity. Jet fuel prices have really not come down. They've doubled. These are European jet fuel prices. So European airlines will be hit. Industrial metal prices going through the moon. So part of this is supply disruption. So aluminium producers in the Gulf are shut in. So the aluminium supplies to the aluminium market from the Middle East have been massively reduced. And also sulfuric acid, as we talked about in previous episodes. Sulfuric acid flows from the Gulf. About 30% of world sulfuric acid supplies come from Qatar. They're locked in, and you need sulfuric acid for acid leaching of copper. So this may be a supply issue, and does not necessarily mean that copper producers are going to be making huge profits, because if they can't get sulfuric acid, they can't produce. The urea price keeps on rising, so this will have knock-on effects on food prices in due course. Now, the analysis I've read is that food prices rise about half the amount of fertilizer price rises with a lag. So if we think that fertilizer prices are up at least 50%, In the course of next year, you'd expect to see food prices rise by about 25%. So the inflationary pulse will take quite a long time to feed through. Meanwhile, China has been steadily supplying Iran with precursors to make missile propellant. And we talked last week about how the Russians must be providing Iran with satellite information to allow them to have targeted US air bases in Saudi Arabia. Well, the FT had a report saying that actually it was the Chinese. The Chinese had sold Iran a satellite which Iran was using to surveil the assets, US military assets anywhere in the Gulf. So, bottom line is that actually very little traffic is currently transiting the Straits, although there remains a lot of oil on water and in storage around the world. And perhaps that is why equity markets are being so complacent about the disruption caused by this war. But the longer this continues, the more supply chain stress there will be until a solution is found. And equity markets in particular seem to have got way ahead of their skis. Now, in other news, so there was an election in Hungary which delivered massive defeat for Viktor Orban, who is a favourite of Donald Trump, and a supermajority for Peter Magyar. So that is great news for, frankly, the European Union and for Ukraine, as Orban had been blocking EU loans to Ukraine. China has announced it will ban all sulfuric acid exports from May. So that has big knock-on effects, as we were discussing last week, with the supplies of copper, silver, and nickel, all of which need sulfuric acid for mining. Russia has announced it will temporarily halt helium shipments starting from May. So again, supply chain stress is building, and the US has threatened it will tear up its trade agreement with the UK unless the Royal Navy helps clear the Straits of Hormuz. He threatens a lot, and so we're sending the king to go and massage his ego. Let's hope it's effective. Now, elsewhere, this is interesting and worrying. So, the electricity supply to the Terzo di Tolmezzo pumping station in Italy was sabotaged by unknown actors. We think we can guess who's behind this, and that disrupted the pumping of crude oil from the Adriatic Sea up to refineries in Germany and Austria for 3 days in March. It wasn't announced until after the disruption had been cleared, but quietly in the background, there is this proxy war of sabotage with, you strongly suspect, Russia and Russian agents going around Europe, disrupting key infrastructure such as oil pipelines and railways, etc. Will that get worse? And sulfur prices are up 50% year to date, and that is in the US. Now, let's do some maths. Because sulfuric acid is actually crucial to the production of phosphate fertilizer. So 3 million tons of sulfuric acid translate to 1.8 million tons of hydrogen phosphate to 1.2 million tons of phosphoric oxide, P2O5, which makes 2.8 million tons of phosphate fertilizer at 46%, which is enough fertilizer for 22 million hectares or food for 330 million people. Now, if you don't apply phosphate fertilizer, you can expect to see a drop in yield of between 7 and 20%. So the loss of food for about 6.6 million people. So the closure of the Straits locks in between 40 to 70 million tons of sulfuric acid, and that equates to potential loss of crop yields of about 2%. So not great. And as ever, that will have a disproportionate effect on the poor. Airfares are soaring. EasyJet announced that they had hedged 70% of their fuel, but every $10 rise in the fuel price cost them 40 million pounds. So airlines are suffering.
These are really extraordinary increases. This is an economy ticket. Hong Kong to London going from $500 to over 3,000.
Yep.
That's quite extraordinary.
Well, they burn a hell of a lot of fuel. And I strongly suspect these are, you know, have they chosen the lowest fare? Question mark. By comparison, I had a look at airfares to Kuala Lumpur because I flew to Kuala Lumpur last year. And so if you were to fly via the Gulf, then they're exactly the same as they were last year. But I suspect very few people want to fly via Abu Dhabi and Doha at the moment. And those fares were less than half the price of, direct flights. So if you're willing to endure a bit of war risk, you can still fly fairly cheaply to the Far East. Now, elsewhere, I thought this was amazing, and this is GPU availability. So it's how intensively people are using AI, and you can see that no matter how fast US data companies are adding data center capacity, the that capacity is being used. So AI adoption is continuing at pace.
Well, Keith, perhaps one small thing that we could do back to Russia is launch Mythos at them. Given if they're going to take out infrastructure related to European energy supply, presumably they haven't got the AI capability to be running something like Mythos. That gives anyone who's got that extraordinary power for however long the window lasts.
Yeah. So what's Mythos, Stuart?
Oh, sorry, Mythos is this new anthropic um, agent which is finding all these backdoors and security flaws in
Right.
every
Okay.
piece of software. It's deeply worrying. They had to release it in a sense in private to other big tech companies. Central banks are deeply worried. Regular
Wow.
commercial banks are deeply worried, and it's uncovering hundreds of security flaws that no one has found, for the past 20 years. It's
Wow.
deeply worrying development.
Well, that sounds great. It sounds terrible for software security companies because they're
Yeah.
being taken out of a job. I mean,
Well, I'm more worried that Trump is going to get hold of it and use it to threaten anybody and everybody.
yeah. As an aside, I had lunch with a friend who works in management consulting during the week, and he was talking about vibe coding. So one of the things management consultants have to do is they have to produce an org chart of the company they've been assigned to. And so you kind of go around the company asking everyone who they report to. And then you take all these inputs and there's a specialist piece of software they have been subscribing to. And you take all these and it produces an org chart for the business. And essentially, he vibe coded an alternative for free in 5 hours using Lovable. And so they're now going to stop using that piece of software. And his view was that a lot of these minor software companies are just, going to disappear, or their pricing power is going to absolutely tank.
Yeah, it's phenomenal, isn't it? The number of stories you hear about people who've just cobbled something together over the weekend, and it's amazingly powerful. My son was showing me, he developed some trend following system over the weekend, and it's
Really?
just extraordinary what can be built so quickly. I guess the question is always going to be about robustness. would get rid of some old supplier for a vital component if you're going to be saving 5 or 10 grand a year, given the risk
Yeah.
that there's some bug in something that you vibe coded over the weekend?
Well, actually, on that point, so there's a board meeting yesterday, and we were talking about a potential client we had been in negotiations with for a year. So we'd been like back and forth with them, like special, like creating a special website for them, try and get them sign on. And they had been just, always asking for more. And it turns out they were stringing us along and trying to duplicate what we were offering them by using Chat GPT. Yeah. And so they went live with this and they were hacked. And all their data was you can actually go into the system, change all the parameters, etc. as a punter. It's like the whole system was just open. You can see all the data, etc., etc. So they've had to, cancel all that and roll back to a very old system. So there are dangers involved in vibe coding.
Well, the FT had a fabulously interesting report yesterday about the robustness of the AI agents. And their basic point was, look, you shouldn't look at the average performance of an AI agent. What you need to look at is what happens when it gets it wrong, not the average performance, but
Yeah.
the performance at the left hand of the tail. And their data suggested that the AI agent manufacturing companies are so focused on the publicly available benchmarks of performance, which are to do with average performance, that
Yes.
no one is really looking at what happens when you get it wrong. And I think that Sarah Connor, she's I think a great journalist, and she was highlighting, look, we need to look at what airlines do, what the nuclear industry does.
Yes.
It's not about being right on average. It's about
Yes.
cutting off the tail of what can go horribly wrong.
Yeah. No, absolutely. Now, in private credit, it continues to get worse. So the trouble is with private credit is that they make loans which are private and therefore illiquid. There is not much of a market for them. So there's always this liquidity mismatch between investors who can demand their money out at day one and the underlying securities, which are difficult to sell. And so as you get more redemption requests, so they're having to be sold in the market, which means their true value is going to be revealed. And one suspects that is not going to be good. So,
There's a complete, well, there's a parallel market with the publicly traded private credit companies, which trade
yeah,
at about a 20% discount to their advertised NAV,
yes.
versus the private credit funds, where
Yeah.
they're pretending the NAV is still real.
Yeah, after my disastrous dalliance with REITs over the past couple of years, it's become clear to me that the NAV is always the most optimistic you can justify.
Yeah,
And
because management is putting pressure on the accountants to take, the central assumption, it'll all work out.
yeah,
Yeah.
so we'll get on to what we have more private credit coming. So winners from the war, same as last week, basically. The only thing I've added is tungsten, and we will talk about tungsten in a bit. Losers from the war were frankly just about everyone. But the market is off to the races. So the market is assuming that disruption in this war is essentially going to be over quite soon and leave the economy unscarred. And on to economic news. So the US GDP numbers, the final numbers for Q4, were downgraded once again to only 0.5% annualized. Reminder, the US economy is actually doing just fine. The reason that it was so poor in Q4 was the government shutdown in October. That seems a very long time ago. We had US CPI numbers for March. So after the start of the war. Reminder, the war started on the 28th of May, so March includes the full impact of the start of the war. And that rose as expected by 0.9% month on month to 3.3% year on year. Core CPI rose 0.2% month on month, but actually was below expectations at 2.6%. So there's no evidence of pass-through effects as yet. Producer price inflation for March rose 0.4% month on month, which I was amazed by. I thought it'd be much higher than that. And only 4% year on year, and that was substantially less than expected. We'll take you through the numbers. Non-farm payrolls for March were plus 178,000. So, according to the official stats, the war has not affected the US economy at all, and job growth was actually very good. The household survey, however, said that total employment had fallen 64,000, and our trust in the non-farm payrolls is obviously not great. It's always revised lower. The general tone of the US labor market can be found by looking at earnings growth, which continued to decline to only 3.5% year on year. So the labor market remains weak. Unemployment fell to 4.3%, which is consistent with jobs growth, but the U6 unemployment rate, which includes discouraged workers, rose to 8%. Turning to the UK, not much data. UK GDP for February, strongly surprised to the upside. Hurrah! Amazing. Plus 0.5% month on month, 1% year on year. And that was mainly due to strength in the services sector. And looking through the stats, the number one contributor within the service sector was car maintenance. So there you go. Lots of more car maintenance going on. UK industrial production remained weak at minus 0.6% year on year in February. In the EU, retail sales were weak, 1.7% year on year. Industrial production weak, minus 0.6% year on year. Construction weak. PMI was at 44.6. So European economies nicked so good. The US just fine. Market news, well, absolutely amazing. The S&P 500 is up an astonishing 7% over the past 2 weeks to a new all-time high. The Nasdaq Composite was up 10.2%. I had to do a double take when looking through these numbers. Oil price is down 10% over the past 2 weeks, but still Brent is just above 90. Gas and coal prices also fell, which is good news for UK consumers. Industrial metals were amazingly strong. Aluminium up 5%, copper up 7.5%, copper back above $6 a pound, nickel up $7. So nickel up 7%. Once again, that doesn't necessarily mean that copper producers are having a good time. That will depend on whether they can get hold of sulfur and sulfuric acid. Precious metals were also generally strong. So gold was up 2.3%, silver up 5.5%, platinum up 4.9%. And coming up, we have SimonW's technical analysis of gold and the other markets, something to look forward to. So the ceasefire announcement last Wednesday sparked one of Trump's bigger relief rallies, although nowhere near as big as the tariff relief rally, and the markets have just kept on rising since then. And it's remarkable how equity markets have risen since the ceasefire. Essentially, they've just kept on rising, even though the Straits remained closed. But the odds on traffic returning to normal in the Straits of Hormuz remain quite low. So markets are rallying despite the fact they don't really believe the Straits are going to open. It's extraordinary. So what's the prognosis? Well, there is no military solution to end the war. So it's going to have to end by negotiation. In my view, it's just a question of how long it takes both sides to find a face-saving solution. Neither side is going to win. Remember 1979, as we discussed before. Iran held the US hostages for 444 days.
Keith,
Ayatollah, go on.
my worry on this is that, as you say, the blockade of the blockade launched by the Americans requires patience. It requires a long time to have its effect. And I find it difficult to believe that Trump isn't going to have some other emotional spasm or need a new episode in his ongoing psychodrama. I fear that there's no ability to apply that pressure consistently and something erratic will happen. So markets seem to be pricing, in a sense, the central scenario, but not really having any sort of discount for the possibility of some extraordinary outlying event, which I would say is not at a trivial level of probability that there's a decent chance of something crazy happening.
Well, I think there's a decent chance the Straits remains closed for an extended period of time. The in that if there is no negotiated settlement, Iran will its incentive is absolutely to stop traffic through the Straits. However, Trump overnight has been saying there's an agreement with Iran is very close, and he's under significant political pressure in the US. And I just think he wants out of this. And Trump, in my books, if Iran were to offer him pretty much anything, I suspect he'd take it and paint it as a victory.
I can totally see that scenario. I just fear that he won't want to be seen to have lost, and that could lead to another round of military action. But my bigger picture here is that markets seem to be pricing a sort of central outcome, which I can see that the reasons and the logic why there's a sort of muddle through, but that the outlying possibilities to me seem to be perfectly credible and not priced in.
Well, spoiler alert, we'll talk about this a bit more later, but on the day of the ceasefire announcement, as you'll know from, last week's episode, I thought he was going to bomb the hell out of Iran. And then I had actually bought some Brent futures and he didn't. He went completely volte-face. We're going to have an agreement. And then I thought, I just read the tone of his tweet and I thought he's not on for this anymore. He just wants out of this. And so I basically committed all my cash to bought mainly UK banks, but
All right.
just everything, frankly.
Oh,
Bought,
nice trade. Well done. Yeah.
well, not necessarily, because it hasn't actually gone up that much in the UK since the US is off to the races.
Mm.
We'll talk about some other things I bought in due course, but that so far has proved to be right. It didn't look right on the Thursday or
Mm.
Friday, but since then markets just keep on rising. Okay, and on to equities. Stuart.
Right. So as Keith has mentioned, generally very positive numbers. The all world up 7% over the past fortnight. Within that, some particularly big rises in the Nasdaq up 10%. Conversely, the UK all share up only about 2%. So very strong numbers across most of the world.
Yeah.
Bitcoin. Sorry, go ahead, Keith.
Well, I was just going to say, look at Far Eastern markets. I mean, because you know that the oil disruption is concentrated in the Far East. And yet,
Yes.
Hang Seng is up 5.1% over the past 2 weeks, and Topic's up 5.6. Amazing.
Yep, very big moves. Well, in fact, yeah, good point to highlight the topics. I mean, that's actually the best performing market this year, isn't it? Up
Yeah.
12%. Bitcoin is continuing to behave like a risk asset, really, up 12% over the past fortnight. The dollar giving back some of the gains it had earlier in the war, so up about 2% against the pound and the euro. And as we keep highlighting, the VIX has been very quiescent, now below 18, so it's fallen by 25% over the past fortnight. So here is the all world index. I mean, look at that V shape. That seems to have pretty much touched a new all time high along with the US, hasn't it?
Yeah. So the markets absolutely believe this war's over.
The all share, more muted reaction, up just 2% over the past fortnight.
Yes, this is having bought, UK banks, they haven't gone down again, but it's like flat as flat as a
Yeah.
pancake since, last week. Uh, in contrast, the US, which is just, off to the races.
Euro Stock 600, a bit better than the UK, up 3.4%. S&P 500, yeah, look at that, the new all-time high going through 7,000.
Amazing.
Yeah. Nasdaq even stronger, so that must have been new all-time high as well,
Yep.
up 10%. Russell 2000, yeah, well, same sort of story, up only 7.5%, but phenomenal. Hang Seng, you're not anything like the all-time high, but
Yeah.
yeah, yeah,
So you'd say that fell more and has recovered less.
a bit less, yeah.
That is rational given the oil disruption in the Far East.
Here's topics that you were talking about. There's a very strong uptrend line. Total anecdotal stuff here, but I'm in Japan at the moment, and the number of people you speak to who are now worried about inflation and the falling yen. I mean, perhaps people are just seeking a haven in a real asset of the stock market.
Yeah.
Bitcoin, yep, it's having a bounce. Well, I suppose in the scheme of Bitcoin's price history, it doesn't look so strong, but it is actually 12% off the bottom a few weeks ago. The pound, well, look, in the scheme of things, look, it's traded between 132, 138, it's bang in the middle.
Yeah. So very high yields in the UK are fundamental support for the sterling.
Euro, sort of similar story, really, towards the top of the range it's been in the past couple of years. But in a way, currencies haven't really been the story over during the war, have they?
Precisely. Yeah. Although they were saying, the safe haven buying of the dollar, is now unwinding, but
Yeah,
not big.
yeah. Which I think the dollar index chart here shows that looked at over a year. The VIX, my God, look at that! Just completely steps right back down to its complacent levels.
I know. Absolutely astonishing.
Yeah.
So some charts related to the news. Um, well, markets are expecting 16% earnings growth in Q1, which is really strong by historic standards. But then when you look at the rest of the year, it gets
Mm.
stronger and stronger. So according to this from the Yardini research, Q1 earnings growth is actually only 13%, but then you're getting up to 21% by Q4. So markets are expecting a very strong year for US corporate earnings and that earnings growth to accelerate over the course of the year. Amazing. There's how much of this is priced in. But anyway, markets are, off to the races. Stuart.
Right. And now this I found to be a very interesting table, but I've got to say it's quite a busy table. So pause and have a look. Now this is zooming way out. This is looking at peaks and troughs in the S&P 500 in its valuation and other measures. But I mean, this is all the way back to 1929. So the columns in red are market peaks. The columns in green are market bottoms, and this is a table showing various measures of the S&P 500. Now, it won't surprise people to know that on things like price to book value and dividend yield, the market currently looks very, very expensive. But you can, in a sense, discount those valuation metrics as no longer being very valid. Now, what my interest in this was really piqued by the fact that when you start looking at the S&P 500 PE ratio at the moment, it's not actually that high, despite the market being at an all-time price high. So obviously that must be because earnings are themselves very high, which is what you've been illustrating in that previous graphic, Keith, with the massive earnings growth expected. Now, this table shows various other valuation metrics. So there is, for instance, Shiller's CAPE ratio. So on the eve of the 1929 stock market crash, that was at 30. We're currently at 40.
Mm.
Price to operating earnings at the just before the Wall Street crash was 26 times, and at the moment we're at 26 times. So you can go through this table and just look at the extremes of valuations. But in particular, I wanted to highlight the second row here, which is profit margins. Now, historically, these were incredibly mean reverting, but we've reached an extremely high level, which has been maintained. We're now at about 13% profit margins, where previously 7 or 8, 9 was pretty much the top. So it seems to me that the aggregate market is highly pricing earnings which are themselves on peak margins. So you might think that the valuation ratios should be inverse to
Mm.
margins. You might pay a lower multiple for profits which were being earned on a very high margin, thinking that that margin would revert. But we have the opposite, where earnings are high, margins are high, and the valuation of those earnings are high. Um,
Yeah.
Now, obviously, a lot of this is to do with big tech and the extraordinary market positions that they have. Obviously, in the past, there have been other industries that looked to be the unassailable future with rosy prospects. But what interests me is the AI capital spending, that the high margins, the super cash generation of the big tech now seems to be rolling over. We've got a capital cycle where suddenly billions and billions of what had been free cash flow is now going
Yes.
towards the AI capex with, I would say, an unclear route to, well, possibly to revenue, but not particularly to profit or cash flow. So to me, the alarm bells are just ringing so loud that you've got a highly valued market, but you've got the sign that the capital cycle has reached, one of these familiar
Yeah.
peaks.
Well, on valuations, and first of all, notice that the furthest column on the right is December, and it has the S&P 500 at 6,845, and we've already crossed 7,000. So clearly wasn't the peak. But also profit margins. Obviously, an increasing part of the S&P 500 is, the big tech companies, which are quasi monopolies. So their profit margins just don't come down and they're very high. And also the other thing that's happening is that successive US governments have hollowed out the competition law enforcement. So you're getting increasing, more mergers, more concentrated industries, and profit margins are less mean reverting than they were. Let's put it that way. But I mean, I would also highlight a road that should be there, but it isn't, which is return on capital employed. And what we know is that the amount of capital being deployed now into fixed assets by the big tech companies is absolutely enormous. And that means unless they can find a way of maintaining their current return on capital, which is extraordinarily high, so they'd have to get huge AI revenues, then their return on capital employed is going to fall, I would suspect, quite sharply.
Yes, well, that is my fear, and obviously that this has been very wrong, because I've
Yeah.
had this view for quite a while. But with the U.S. market being what 70% of global indices, the the domino risk of investing in other equity markets so you maintain some equity exposure still feels
Mm.
risky on the assumption that they would go down as well as the US if and when any sort of correction happened.
Yeah. Momentum is back on. I thought this was a great chart. This is the global momentum factor, and look how strong it's been.
Very
Buying.
interesting. Much stronger outside of the US than in the US.
Yeah. Well, that's Japan, isn't it?
Ah, good point.
Now, you can trade this. So there is an iShares Edge MSCI World Momentum Factor ETF. Now, I bought this, and actually, more than that, We've talked previously about how to invest when capital gains tax is 24%. You can't trade. Every time you trade, you're going to be paying 24% of your net gains. So the less you trade, the better your performance is. And I have been searching for um, an ETF where I can basically just put it in and forget about it in the main account. I mean, I'm not talking about your SIPs or your ISAs, they're fine. But in your main account, you need to find a structure that means you don't have to pay capital gains tax. And this is rebalanced every 6 and 12 months. So you sell out of what's been doing well previously, but it seems to have peaked, and you buy what's now doing well. And that happens within the ETF wrapper and does not result in you paying a CGT bill. So I've told my kids who they have SIPs, aged about 20, and I said, like, just put it in this every month when you get your SIP money and don't touch it for the next 40 years because this should compound. What's amazing is even during the pandemic, this didn't do too badly, frankly. Buying what's been working seems to be a good strategy. So I put some money in this. So going forward, I'll be aiming to put a large chunk of my main account on which I pay CGT into this and just forget about it and then spivvying around in my SIP and my ISA. Stuart, your thoughts?
I'm very interested that in early 22, it wasn't a sort of high beta version of the equity market drawdown. I mean, I would have thought if you were just going to buy something for 40 years and not look at it, you would just buy, a world tracker, plain vanilla.
Yeah.
The fact that momentum didn't get whipsawed too bad, I find very surprising.
The performance over the last 10 years has been absolutely extraordinary.
Mm.
So I've tried to find a point at which both the momentum ETF and its equivalent, so US dollar accumulating fund from the same issuer, um, have data for. And so over that period, about 10 years, the momentum ETF has returned 337%, or 36%, sorry, and the MSCI World has produced 257%. So that is a decent differential, actually. And I like the idea. So I'm just going to buy that and forget about it. Now, if you don't like the iShares, there is another one from X Trackers, which tracks the same index, but it has slightly lower performance.
So the chart here is the PE ratio of the S&P 500, which was getting not too unattractive,
Yeah.
below 20, a few weeks ago, which is what prompted me to start looking at those other valuation measures. Sort of, if you're on a PE of 20 for the S&P 500, that doesn't sound too bad. Hence my interest in that table of trying to look at longer term earnings and profit margins. So, well, I think we come to the same conclusion that if big tech can maintain its profit margin and return on capital now, or at least then, when this chart was cut at the end of March, did actually look reasonably attractive on a valuation basis.
Yeah, I mean, one thing that I've, missed over the past few years and missed out on much of the rally is that when you think about, US corporate earnings have been astonishingly strong. And when you think about, the Kalecki-Levy model of where profits come from, the US is running an absolutely extraordinary deficit that we thought was going to be 5.8% this year, but the latest numbers I'm seeing are that it could reach 7% this year
Extraordinary, yeah,
during a period where the US economy is doing really well.
yeah.
Now, how sustainable that is and how that ends, we'll leave for another week. But, that is something I'm increasingly concerned about. Um, then, plus investment and investment in AI data centers is, we know, contributing between 1 and 1.5% to US GDP. So investment's been very strong. And that feeds through to other companies' earnings and then dividends. And, companies have been all been doing well. So the, three drivers of corporate earnings growth have been very strong.
Keith, so one further thing I should have added when I was looking at that and describing that table, well, firstly was to acknowledge who made the data. That's a guy called Chris Bloomstram. Now he writes a very detailed annual analysis of uh, earnings progression within the S&P 500, including in which is a measure of share count. Now, he observes that despite all the massive amount that's been spent on share buybacks over the past 10, 15 years, that the overall share count within the S&P
Yeah.
500 is basically unchanged. So
Yeah.
implicitly, so much is being issued to management and employees via share options that you're actually running to stand still. And
Yeah.
on his numbers, roughly a third of operating cash flow gets paid out in dividends, and the remaining two-thirds, in effect, goes towards share buybacks to offset share issuance. So, you know,
Yeah.
there is a sort of accounting sleight of hand that's going on to present earnings as being strong, where you could say you're working against a tide of 1 to 2% a year continual ownership dilution.
Well, I mean, my thoughts on the market, Stuart, is that, the last couple of years I've been fighting the market because I thought I, had a strong macro view, which had turned out to be totally wrong. And since I've been started making money again, I've just decided, right, sod that, I'm going to be nimble. So, I'm just going to follow this for while I think it lasts. And right now, it just seems this market wants to go up. So, I'm going to follow it up. Now, this is the performance of software companies versus hardware companies, and it's been doing very badly, frankly. And there seems no sign that a turnaround. I really wouldn't be bottom fishing in software. So there is so there is a software sector ETF if you want to go bottom fishing, and you can see that over the past 5 years, essentially flat, but the trend ain't looking good. However, agentic AI shares are doing all right, much better than diversified software companies. Now, the AI ETF actually looks okay, but when you look at what's in it, it's mainly hardware. So that explains why the AI ETF is doing okay. It's AI hardware companies, not AI software companies. Within the software industry, valuations have collapsed, but I think they've collapsed for a reason. I wouldn't be bottom fishing. The information technology sector, though, as a whole, has done absolutely great, and that includes Nvidia, etc. I thought this is an interesting chart. So the physical economy, so industrials plus materials plus utilities, is now only 17% of the S&P 500, and that's been falling. So, as Nvidia and the software companies have been doing incredibly well, or AI technology companies have been doing well. So, you know, the rest of the physical economy has been neglected. Is that about to change? Meanwhile, Blue Owl, which is a harbinger of what's happening in private credit, share price just keeps on falling. And last week, Jamie Dimon warned that losses in the private credit industry would exceed expectations due to weak lending standards, use of payment in kind interest on its loans, and borrower performance. So, payment in kind is where instead of paying interest on your loan to the private equity company, what you do is you issue them more debt. So, unless that debt can be paid off, it's not a winning game. And private equity and private credit are heavily exposed to the declining software market. 50% of their loans were software. So The two are linked, and a lot of tech debt is going to be refinanced in the coming years. So be careful about software companies. Now, the BDC index looks at business development companies, which are publicly traded private credit companies, of which Blue Owl is going to be a constituent. And if you were to wish to go bottom fishing in private credit, which I think would be a poor idea, um, you could trade this. Don't say we don't give you investment ideas, things to avoid. Um, and this is the cost of training various models. OpenAI are forecasting they're going to spend billions, hundreds of billions of dollars in the coming years on training their models. Now, remember last week we were talking about how they were um, offering 17.5% interest on preference shares to raise capital. This is OpenAI. And I just don't think the numbers go up. If they can only fund themselves at 17.5%, they go bust. Stuart, your thoughts?
I'm going to have a bit of a kicking of Sam Altman. There's been so many reports of he basically trying to analyze his behavior and sort of coming to the conclusion that he's a bit of a sociopath. He'll say anything to anyone to get
Yeah,
them on side at the right time. And they're producing timelines of what he said 5 years ago versus what he did, and it time and again he seems to be the world's best salesman. The fact that you can raise 100 billion and that money is going to be burned over the next couple of years. It's quite extraordinary. People's fear of missing out and their ability to be drawn into this sort of nexus. It, in a sense, I'm so glad that these are not public, not part of the
yeah.
public indices, because it's just a fabulous story, literally fabulous. That you
Mm.
if you start with a pen and paper, work out even roughly what's going to happen. Now, all the orders of magnitude are wrong in terms of how are you going to get to any sort of profitability. I'm reminded of when I first studied any sort of accounting that you were told that sales are vanity, profits are sanity, cash flow is reality, and
Yes.
even at the vanity line, we're so far off
Mm.
generating the revenues to pay the interest on the debt. It's the numbers are off by orders of magnitude.
Yeah, the FT had an interesting story this week about trying to get AI to do some sports betting,
Oh
real
yeah.
world applications. Answer wasn't very good. OpenAI in particular went bust. They're yeah. So in real world applications, in coding, apparently, Anthropic Claude is very good, but we are, it remains an open question to me. Yeah, how
And yet
useful
valuations are
models?
not open at all.
Yeah,
The bets are all on, and the valuation is extraordinarily on that this will be a winner. I mean, it just seems
yeah.
to me that the number of models out there, all based on the same underlying technology, mean that it's going to be difficult for any particular company to be truly differentiated. So, who's going to benefit in a slightly undifferentiated market is much more likely to be the customer via low pricing than it is to be the manufacturer, who's spent all the money.
So one of the things I've noticed, Stuart, as an aside, is that when I've been like investing recently, I have typed in things such as please recommend some UK listed gold miners. And what it comes up with is dated. So the it's clearly been trained on historic data, and it will come up with some recommendations of companies which have since merged or been taken over. Or it will describe a company which now has, frankly, huge producing assets as a development company with, mines that are yet to come into production.
Mm.
And you think, you know, it's good if you just want to, come up with some names but actually the usefulness of the information it's coming up with, I question. Um, Meanwhile, AI company revenues are real and they are going through the roof. So AI revenues for Anthropic have gone from 1 billion to 30 billion in a year. Extraordinary. Now, this is interesting. When we talk about private credit, of course, there is, 3i is the UK's largest investment company, and its shares have absolutely tanked this year. Do you hold any of this, Stuart?
I don't. Sorry, just to slightly correct you, Keith. This is private equity, not private credit, isn't it? With
Yes.
three I.
So,
Yeah.
yeah. Sorry, I meant private equity. And its shares have absolutely collapsed this year. Now, the reason is that 3i is essentially the value of its largest position, which is this Dutch discount retailer, Action, which represents 74% of the value of 3i. And 3i had valued that at an aggressive 18.5 times EBITDA, which is only justifiable if it keeps on growing very quickly. And when it announced latest results, they weren't, their growth seemed to have slowed. And Frio also said that it was taking action into the US market, which is notoriously a graveyard for European companies, retailers of any kind wanting to expand. All that led to a sharp re-rating. But once again, these like investment companies, the valuation they put on their portfolio companies is frankly, I think, the most optimistic that is justifiable. And
Sorry, Keith. Sorry,
oh,
just that is extraordinary, isn't it? 18 times earnings before interest,
yeah,
tax, depreciation, and amortization. I would have thought 18 times after
yeah,
interest, tax, depreciation, and amortization would be going it. That is
yeah.
phenomenal.
So you're absolutely right, Stuart. We have become normalized, or I've become normalized to thinking of, everyone quotes EBITDA, which is the last refuge of the charlatan. So get rid of, particularly for private equity companies who you've stuck it full of debt. Yeah.
Yeah,
Um,
phenomenal.
Anyway, so the other thing, and this is true bull market symptom, frankly, is that 2 days ago, this shoemaker in the US, Allbirds, announced that it had a change of strategy and it was going to be an AI infrastructure company, and its shares shot up by 580%. Now, this is so .com, frankly. Yeah, and I just
This is just meme stock stuff from 2020, 2021, isn't it? This is just
yeah.
extraordinary.
But I mean, to me, this is very indicative of where we are in this market. The market, this is a raging bull market, frankly. And
Don't you think that there's something sort of almost appropriate that in a world where you've got Trump and Hegseth, leading, charging around the world, causing chaos and havoc, so that they can have ratings and attention and the next episode in Trump season 2. It's sort of a piece with the fact that there's a sort of nihilistic um, behavior in markets as well. That there's a sort of
yeah,
cultural overall decadence and decline implied in this.
yeah, no, you're absolutely right, Stuart. It's everyone's just playing games. There's like nobody believes in the fundamental value of anything. It's just like,
Yeah,
is it
well,
going to
ignore
go
my
up?
table then from previously. That was all about fundamental value.
Yeah. Talking about fun and games in the markets, this is Avis, the car rental company. And what's going on is a huge short squeeze. So the shares have gone up 350% in the last month. Essentially, somebody spotted that there were lots of, it was heavily shorted, and they've been buying options, etc., etc., in a very GameStop manner and squeezing the share price higher.
It's extraordinary. I believe the two largest owners of Avis, if you include not just the shares, the ordinary shares they own, but the contracts they have with investment banks to give them economic exposure to the shares, the two largest put together have got 108% of the overall market capitalization. So it's the
Yeah.
two largest owners who are squeezing the shorts.
Wow. And you may have seen that Iran is demanding that anyone transiting its waters pay it tolls in Bitcoin. Hurrah! Finally, an actual use case. So there you go. But Bitcoin is going up. And if you want to circumvent US sanctions,
Hold on. I thought Bitcoin had its blockchain ledger, so you'll be able to see which wallets have paid and which have received. Won't that enable you to trace things in the future?
yeah, absolutely. But that's true. And also, presumably the US could shut this thing down in a day if it so wanted to. But, Trump has his own coins and is very pro Bitcoin, He seems like
Yeah.
remarkably relaxed about the whole thing. And on to commodities. Now, I thought this is quite an interesting chart. So this is a claims to show the ratio between gold and the S&P 500. And basically, when gold starts outperforming the S&P 500, it presages a continued rise in both precious metals and commodities versus equities. And as equities are going to the moon, this rather suggests that commodities will also be going to the moon. You heard it here first. Anyway, on to energy commodities. So the ceasefire has meant that oil prices, gas prices, basically the whole energy complex has fallen over the past couple of weeks, though it still remains high by historic standards. So Brent is 98, down 10%. WTI down 17% to 93. Dutch natural gas futures down 15%. UK natural gas futures down 16%, though still up 44% on the year. US natural gas prices, amazing, just not moving at all on global tensions, down 28% on the year. Coal down on the week, but still up 25% on the year. Uranium grinding slowly higher. So this is Brent, dropped on the ceasefire, but still very elevated and showing little sign of going down. Uh,
Keith, so
oh,
just on the rough numbers. So, we looked at the reduction in exports, say, from Saudi Arabia. Um, has the price increase, roughly offset the volume decline? So I'm just thinking for Saudi Arabia, whether actually they're not losing too much money from what's going on.
that's a good point, actually. Yeah.
So prices are up, so roughly 50%. Is that
Yes.
roughly?
Yeah. So
So
they haven't
yeah,
halved their oil production. It's down a lot, but it hasn't halved. I mean, Iraq, their oil production has absolutely collapsed. They will be suffering. But Saudi and any oil producer that can keep on producing, particularly if you're in South America or North America, a doubling of the price more than doubles your profitability because you've got fixed costs.
yeah.
Now, there is a big disconnect between oil prices of all kinds. So quickly, when we report that Brent is at 98, what does that mean? Well, we are looking at the ICE Brent index, which represents the 25-day forward Brent price. So it's not spot. And furthermore, for conspiracy theorists everywhere, Brent is paper barrels. So the Brent index is paper barrels. It is not physically settled. When the future expires, then it's cash settled on the Brent price. You don't physically deliver barrels. The people who are long do not deliver barrels. Now, it's an index calculated on trading activity in Brent 40, various oil from various different North Sea fields, plus actually WTI. And any futures positions that are left open at expiry are forcibly settled at the index price in cash. Okay. And now it is arbitrageable. So the index price and the price in the markets should be the same because arbitrageurs can come in and create futures and sell them while buying in the market for future delivery. Now, the reason we're talking about this is because there's a huge difference between spot Brent and the price we are reporting, which is the 25-day futures price. So spot, and these are figures they're reported once every week by the EIA. That's the best data source I can have. And that's, so this last data point is for the 13th of April and is 123.8. So we're reporting Brent is 98. The spot price is much higher. So the futures price is expecting the spot price to fall from here. But as you can see from this chart, the spot price ain't been falling because the actual physical market remains tight because we're running out of crude because the Straits are closed. Okay, WTI down 17% the past couple of weeks, 93. Now, looking at numbers specific to the oil market, well, this is interesting. So total US crude inventories fell by 14 million barrels over the past couple of weeks. So that's what? 1 million barrels a day? Now, excluding the Strategic Petroleum Reserve, they fell by 7.6 million barrels a day. So the difference, which is releases from the SPR, are 6 million barrels. Now, I thought that the US were meant to be releasing 1 million barrels a day from the SPR, but they ain't. They're releasing 500,000. US crude production, no sign of any supply response, keeps on drifting off, down 60,000 barrels a day over the past couple of weeks and down 230,000 barrels a day since the start of the year. There's no increase in the rig count. So shale drillers are not responding to higher prices by getting to work. Reminder, if they were to start drilling a well now, it'd be around 11 months before any new supply came online. Okay, now we have also had EIA global inventory numbers, and those are for March, which is a full month of the war. And I really, really struggle to believe this. So what they are saying, and you're looking at the bottom row here, is that in March ended at 2.8 billion barrels, down 44 million barrels on the month, sorry. And that equates to what? 1.3 million barrels a day out of storage? Seems absolutely extraordinary. We reckon that the oil market's in deficit by about 6.6 or 7 million barrels a day. Certainly much more than 1.3 million barrels a day. And also, they have continued to downgrade their historic numbers. So last month, we were reporting that at the end of December, there were 2.84 billion barrels in storage. They've since reduced that by 9 million barrels. So continually revising down their estimates of how much oil is in storage. So once again, everyone's saying that the oil market was in glut. Well, really? And it's not just traffic through the Red Sea that has been disrupted. Essentially, the black line is traffic through the Red Sea that has never recovered from the Houthi attacks in 2023. And last week, there was an attempted hijacking in the Red Sea by Houthi rebels, we believe. And so that means that a lot of tankers and container ships are actually going round the Cape of Good Hope. So that also explains why there's so much oil on water at the moment. Now, this is the latest from JP Morgan talking about productivity in the various shale basins, and productivity in the Permian continues to decline. These are Saudi crude exports. On Stuart's point, they're not down half, although actually they're down almost half.
Not far off, actually, is it?
Yeah.
Yeah.
So their revenues will have held up. And finally, this is Argentinian oil production from their shale plays, and that has risen very sharply. So it's doubled pretty much in 5 years and is forecast to reach 1 million barrels a day by 2030. But, in the context of the global oil market, that represents what? An extra 160,000 barrels over the course of the next 4 years? That's trivial. Nothing can replace the extraordinary surge in production from US shale, which we think is now coming to an end. So these are EU natural gas futures. Hurrah! Coming right down. UK, similar. Extraordinary surge due to the war, but now fading. US, amazing. Down on the year, going nowhere. And we talked previously about this, but the EIA essentially saying that US can keep on growing its natural gas production for the foreseeable future to 2050. US has got loads of gas. It's difficult to see anyone making decent profits there. You can just drill another well and get more gas out. Coal has had a great run, but now appears to be drifting off as tensions in the Middle East hopefully are easing. Uranium slowly grinding higher. And I thought this was interesting. When you look at the number of nuclear reactors that are in the process of being planned or built, that's a lot. That looks to me to be roughly doubling the size of the existing nuclear fleet.
Oh, I see Uganda is putting in a good show there.
Yeah.
Look, they're mid-table. I hadn't heard about the Ugandan
Oh,
nuclear power
yes, you're right.
program. Yeah.
Yeah. Well, it's amazing how many countries are planning to build nuclear reactors.
Well, I just hope that we can copy one of their designs, don't fiddle, and just implement it.
Yeah. Yeah. We live in hope, Stuart.
Yeah.
Uh, so the IEA is forecasting that nuclear capacity will grow 31% in the next 5 years. Not double. I mean, these things take years and years to build, but you are seeing growth in the nuclear fleet, which is a change. I mean, it was shrinking for many years. Okay, and on to industrial metals, Stuart.
Right. Well, here we go. As we were highlighting before, supply constraints mean that there's sort of general upward pressure. Aluminium up 5% over the past fortnight, and copper up 7%. Lithium carbonate also up 5%. Nickel and neodymium up 7%. So general upward pressure over the past fortnight, and some pretty big numbers year to date,
There are.
including aluminium up 22%.
Yeah, absolutely. Big numbers. Now, the question is, this is not, the question is whether this equates to rising profits for the mining companies. And that really depends on whether they can keep producing, whether they've got, access to diesel and access to sulfuric acid. So just because the copper price is going up doesn't mean your little copper producer in the Zambian copper belt is necessarily doing very well, because
Mm.
it needs sulfuric acid and it needs diesel.
So here is the aluminium chart. My goodness, that looks very strong, doesn't it? Like reaching for the moon.
Yeah, but we're there's a lot of aluminium that's stuck in Qatar.
Gulf countries are amongst the largest producers of aluminium. So we've got China dominating. What's that about? Sort of 60% or something.
Yeah,
But the GCC countries are third on the list. So pretty chunky. Cobalt price, flat.
yeah. Well, it's managed by the DRC.
Yeah. Copper, there we go. Again, a big reach upwards from 5.5 pound dollars per pound to over 6.
Okay, so we have recorded the copper special, part one, on all the copper basics, and I will edit it and get it out this weekend.
Here's the iron ore price. That seems to have had its roller coaster somewhat earlier than the other industrial metals. But anyway, back to pre-war prices. Lithium, again, I'm not a chartist, but it seems to me you've got rising bottoms there, if that's the correct term.
Yeah, that seems to be in a channel, doesn't it? I mean, that looks like it really wants to go up,
Mm.
even though we've got loads of lithium.
Neodymium, that seems a somewhat dilute version of what we've seen elsewhere. Nickel, oh, look at that, stretching up from
Yeah.
trading lows to trading highs, isn't it?
Yeah. Well, this is Indonesia, finally caring something about environmental destruction
Hmm.
and putting some limits on nickel production.
Tin, again, yeah, stretching back up, not quite at some of the spiky highs earlier this year.
Yeah, but the whole metals complex is just incredibly strong.
Well, yeah, here we go. Zinc, that seems to have returned to its previous strong uptrend. And now precious metals. So some bounce back, really. Sort of not quite in the same strength as we've seen in equity markets, but gold up 2% over the past fortnight, year to date 11%, silver 5 and 8, platinum 4 and 2 or 5 and 2%. So here's the chart for gold. I mean, that isn't really quite the same as the Nasdaq, let alone of equity markets. So it's sort of halfway back to its top, really, isn't it? It doesn't look totally convincing to me.
Yeah, I'm actually increasingly coming around to Richard's point of view. We'll do a long section on this possibly next week, but I'm very worried about actually the quality of modern democracy. And that means, prudence and retaining the value of the currency. And nobody's up for it. Nobody is up for fiscal prudence.
Yeah,
When you
isn't
look
that
at,
true? Yeah.
yeah, and ultimately the whole system relies on fiscal prudence and not monetary debasement. And when you look around the world, nobody's up for it. They're all like, the US is running a deficit of 7% in the good times. And we've got some numbers on the deficit coming up. And you think, this can't carry on forever. How does this end? I just don't see it.
Well, I think you're right. So I have from a couple of years ago started maintaining a constant position in gold, purely from a sort of portfolio construction perspective of insurance against that sort of disaster scenario.
Yeah. So one of the things I bought this week, and I've been buying in some size actually, was precious metal royalty companies.
Mm.
In them, I mean, they've had an amazing run, but on a 5-year view, I just can't see, I just don't think this ends well. Trump leaves office in 2028. Okay, so we've got another 2.5 years of this nonsense. And the deficit is running at 7%. So it's about 1.8 trillion a year. So, by the time he leaves office, he's going to have added another 3.5 trillion minimum in debt. And, interest rates are high. So that means that the interest expense just keeps on going. There's about 20% of the US deficit. So 20% of US tax revenues are currently spent on interest, and that's going to rise to 25, 30%. I mean, it's just totally unsustainable. And then what do you do? The big question is then what do you do? Because if you try and rein in the deficit, you are going to crash the equity market and you're going to, and that, the US
Yeah.
economy is very dependent on the equity market. And so you crash the US economy. So I think they're in a trap that I just really can't see a way out of.
Yeah, yeah. I mean, it maybe yet more monetization. get more debasement, hence gold.
Yeah.
Uh, there was a part of me that for a while was thinking that tips at 2% real was a good bolt hold, but you've got to think that a government will find some way to renege on that. So it does
Well,
push it back to.
I think to tips of 2% is good, you know, as long as there's no Argentinian style manipulation of the inflation index, and as long as there's not some sort of corporate default, sorry, sovereign default.
Well, Trump would never do either of those.
Well, he has talked about defaulting on foreigners, so
I know he has. Yeah, yeah,
yeah,
quite. Right, central banks have apparently still been buying gold. I just don't know enough about this market to know how reliable this data is. I mean,
yeah.
who is obliged to actually publish the accurate data? I mean, what does China do? Does it reveal exactly what it's been doing? Presumably, it's got various proxies via state-owned banks that could hold the gold.
Mm,
I just know that I don't know, but I'm
yeah,
skeptical of the numbers.
true.
Gold reserves have eclipsed adjusted dollar reserves. Not quite sure what the adjustment is here, but I can totally see how obviously the rise in the gold price has meant that the value of gold holdings has zoomed up over the past couple of years. So, well, in a way, it'll be interesting what central banks want to do from here, because in a way that they've got a reasonable position now.
Well, this is also a decline in the reserve status of the US dollar story. So,
Mm.
since the US started, seizing Russian bonds, you know, everyone, China, etc., have been diversifying away from US assets. And, US fiscal imprudence has undermined confidence in, the future value of US bonds, I would say.
Yep.
So congratulations to everyone which is all of you, who were there before me on this issue. But I'm finally getting the message.
So, Keith, for you, that'll be a strategic position. It won't be something for you to be trading in and out of.
No, no, I'm just holding those forever, basically. Honestly,
Right.
in my main account, I'm going to be progressively stopping spivving and moving into anything which doesn't, I can hold forever and not generate a CGT bill. At
Right.
24%, you can't trade. Full stop.
No, indeed. Yeah. Okay. The chart, the figure here is looking at ETF demand for gold, where within the US that appears to have really weakened massively, whereas in China there's still demand via ETFs.
Yeah. It's a really interesting chart, isn't it?
Mm.
So US punters, have sold gold to meet margin calls, etc., as you always do in a risk-off environment.
Right. So what have we got here? French central bank nets 13 billion by pulling gold out of US reserves. Ah, so is this a question of that they want the money, or they just don't trust the storage facility?
They don't trust the storage. So what they've
Mm.
done is they've sold it in New York and they've bought it in London.
Oh, right. So they didn't have to hire a ship and a whole, flotilla of boats to ship it back.
No,
No.
no.
Well, haven't the Germans done this, or are they just talking
Yeah,
about it?
everyone's doing it. And
God, that-
so they're basically but trust in holdings in the US collapsing. If you start attacking all your European allies, threatening them with X, Y, and Z, one of the first things they're going to do is try and protect themselves from the threat that you might seize all their gold.
Goodness, I think this is also another interwar thing. I think that happened then as well. People
Yeah.
repatriating their gold.
Yes,
Yeah.
absolutely.
Silver, I know even less about them than gold. I just see headlines and news reports about how there's a squeeze underway, but the price
Okay.
is
So I actually, have got religion. I bought some silver.
right.
Now, and having said that I thought it was going down, I essentially sulfuric acid I think that, the monetary debasement story is real, but also the sulfuric, a lot of silver is produced as a byproduct of copper. And the disruption to sulfuric acid means that you're going to get less silver, and the silver market's already in deficit this year. So I bought a little bit, and I mean a little bit, of silver.
Platinum, I know even less about this than I do about silver, which I know less about than gold. So,
Hmm.
have you got a
Well,
story here, Keith?
no, it's just, the EV transition is happening, less quickly than expected. So all the PGMs are doing okay, having been bombed out, and also, store of value, anything physical. Basically, we're seeing a movement away from finite, pure money forms of assets in the form of like bonds, value has fallen, and buying anything physical.
Rhodium has come off a bit. That's not looking particularly healthy. Palladium, it seems like a reluctant bounce to me compared to the others.
Okay, and onto rates, and really, really not good in the UK. So yield curve just hitting the highest it's been in a year across the curve. And look at the you know, essentially the 1 year. The 1 year is forecasting. Sorry, the 1 year is at about 4.25%. So pricing in two Bank of England rate rises. Really? Or has the Bank of England just lost control of the yield curve? I suspect the latter. I don't think the Bank of England is going to be raising, frankly. US, similar, you know, long bond yields keep on rising. So that is the cost of borrowing for the long term. In the case of in the US, we know house prices are up and mortgages are 30-year. So, very difficult for families in the US to afford a new house. Now, I thought this is an interesting chart. Pause, take a look. On the left-hand y-axis is the Labour share of GDP, and on the right is R star, the natural rate of interest, and the neutral rate of interest, I should say. So what it's showing is the two are linked, very highly correlated, and actually, given the continued fall in the Labour share, so pricing power of labor, basically, how much of the economy is going towards labor, then R star should be coming down.
What's the logic here that when workers are being squeezed, stroke exploited, that interest rates need to be lower to encourage the economy to grow? Is that
Well, it's
the
an
logic?
empirical observation. I mean, the theory is that labor has less pricing power, essentially, than when the labor share is lower.
And this is the real rate of interest, isn't it?
Yeah,
Is that
that's right.
right? Right.
The real neutral rate. So essentially, what you're saying is it should be around inflation, because it's zero. If
Mm.
the red line were to hit the blue line. Now, the commentary was all the other way round, I have to say. They were talking about how the Labour share should come up towards our star. So, anyway, but the 30-year bond yields around the world show essentially who has run out of fiscal space. Number one is the UK. So, the bond market is the one that is disciplining the UK to keep its deficit in check. It's telling the UK it can't borrow more. If you are Switzerland, your 30-year bond yield is like 0.6 or something.
Yeah.
Now you have room to borrow more. UK, it don't. And so UK 2-year yield has shot up, but is coming down. 10-year shot up, not really coming down. This is a bad number. This is a really bad number. And when I was buying everything last week, I bought a bit of the 30-year here. So, with my usual timing and aplomb, that is like total disaster. Thankfully, only a very small position, but, not great. You know, these bond yields matter. So if you are in the UK, you are trying to fund a business and you want a long-term loan, like let's say the 10-year, then the risk-free rate is 4.8%. So what are you going to get? 10 minimum? That's a lot. And that is a huge increase over the past few years. It's not so long ago when UK interest rates were, the 30, it was like less than 1%. So that affects like credit availability in this country. US 10-year has not shown anywhere near as much of a jump, even though, the US is running a fiscal deficit of 5.8% and rising. German 10-year also towards its highs. French 3.7%. Italy, lots of commentary comparing the UK and Italy, sadly.
Mm.
Also off its highs. Greek 3.8%. This is the Japanese still rising. And the Bank of Japan has actually begun to shrink its balance sheet. Its JGB holdings down 10% from their peak, and it's now begun to sell its equity ETFs and REITs. Current investment themes, well, no change really. Mainly disruption from the war in Iran, and now the end of that disruption, and markets basically back off to the races. So the key themes we're looking at, well, that number one is fading. We're back to AI disruption. And notice that anything with AI in the word is now going through the roof, all birds being an indication. Monetary debasement is increasingly on my mind, actually. We are still on the lookout for fads. If you know of any fads, send them in. Fads go to the moon. And on to this week's economic data. Stuart.
So, in summary, UK, well, it's the same story of stagflation turning to stagnation, which is now turning back to stagflation. European Union, stagnation is turning to stagflation. And in the US, the latest data suggests the US economy may finally be weakening a bit. And as Keith has indicated, there's also continual evidence of the fiscal incontinence. So the UK data in a bit more detail. GDP month on month. Well, this was a surprise, wasn't it?
It
February
was.
plus 0.5%, meaning year on year 1%. Beat expectations. Well, long may it continue. Excuse me for being skeptical. And here is the breakdown of that good GDP number. I mean, this is monthly, so it's bound to be noisy, but big contribution from services. Production was not too bad. Construction remains a drag.
Yeah, I mean, so this is actually 3 months to February, but it's encouraging that production has returned to positive, despite our very high electricity prices. The construction sector is going to struggle given that interest rates have risen so much.
Yeah. Industrial production month on month, February 0.5%, beating expectations of just 0.2. Still means that there's year-on-year contraction though. Construction output year on year, as Keith's just been highlighting, it's against a very tough context, so down 1% year on year in February. The retail monitor year on year, well, surprisingly not bad at all,
Yeah,
3.1%. So
yeah, I was
some
surprised
people
by
are
that.
spending. Yeah. Construction PMI, oh goodness, a bit better than weak expectations, but at 45.6, it's still walking
Yeah,
through sand, isn't it?
yeah,
Not being able to get anywhere.
yeah. I just think construction's really going to struggle given increased bureaucracy and high interest rates.
Yeah. New car sales, 6.6% in March against expectations of just 1.5%. So is
Yeah,
this all the cheap Chinese EVs?
it could well be, but I was very surprised that, the UK consumer seems resilient, and that was during, the month of the war.
Mm. Oh, right. Here is Chinese automakers are going, a few years ago, just about 4% market share to about 14 now. And I just want to highlight here the great series the FT has done on the Chinese manufacturing sector and the involution that is experienced in China, which is basically volumes, sales, no
Yeah.
regard to profitability on cash flow, and a grinding inability for the rest of the world to compete against the huge volumes being pumped out.
Yeah.
That does mean cheap products for Western consumers, but it also means further hollowing out not just of Western manufacturing, but of nascent countries in, for instance, Southeast Asia, when there's a
Yeah.
well-trodden path, copy Japan, copy Korea, of going up the value chain, but it's all being monopolized by China. So Vietnam, Thailand, Malaysia, Indonesia, they're up against it. Oh, sorry, that was a bit of a bit
That's
of a
all right.
sidebar away from UK economic data. So returning to that, UK house prices month on month down by 0.5%. So year on year rate of change now at 0.8%. I don't think anyone's really surprised, given uncertainty in interest rates, that house
Yeah,
prices are going nowhere. Probably healthy long term.
I agree.
Trade balance. Shall we move on?
Yeah.
Indeed, jobs postings. No sign of any uptick there, still dribbling off.
And, well below, 30% below our pre-pandemic levels. Really
Mm.
astonishing.
UK inflation down in April, according to Trueflation. Well, I mean, this data may be useful in retrospect, but you know,
Yeah.
it jumps around so much and revised so much, isn't it?
Well, I mean, frankly, to me, I was skeptical about trueflation, and I went back to like reporting it for the UK. But how, given that, we know petrol pump prices have shot up in the UK. How on earth has inflation in the UK fallen in March and April?
Yeah.
I give up. We're going to stop reporting it now. It's nonsense.
Okay, this is a chart that I forwarded to Keith because I think it just puts into context the Iran war versus the disruption in the Ukraine war. This is the UK electricity spot price, which zoomed up, of course, during the UK, well, at the beginning of the Ukraine war, reaching 550 quid per megawatt hour. The rise that we've seen from the effects of the Iran war is just barely perceptible on this chart. It's just a different order of magnitude entirely.
Actually, while we talk about UK electricity prices, did you see that when the sun was shining last week, that the grid was paying energy users to use the excess electricity, due to we're producing too much solar, and it's April.
Yeah.
What's going
Ah,
to happen
right.
in July and August? And as we push towards, more and more renewables, electricity prices in the day when the sun's shining could absolutely collapse. And actually, I was thinking about, solar REITs. Once they sell when they set up the solar farm, they get a guaranteed price from the government. But when that's off, you could see none of these things making any money.
Yes. Well, just to clarify, I think the solar REITs, half of their revenue was coming from a straight government subsidy, which gets passed through to our bills, and half comes from their sales into the merchant market. So
Yeah.
the sales into the merchant market, they are going to become more and more difficult. In a sense, renewables are cannibalizing renewables. The more that comes on, the more you've got these balancing problems, and therefore the more you need to invest in infrastructure to move the power around the grid, and the more you
Yes.
need to do in terms of shifting demand to match it to supply. So we're in a tough spot. We need to get the infrastructure built, and also we need to move to much cleverer use of electricity.
Yeah. I thought that was very bearish solar and potentially bullish batteries, utility scale
Yeah.
batteries.
Yeah, if one can get enough of them built, which is a
Yeah.
perennial problem. Yeah. Right. Workers have barely had a pay rise since the 2008 financial crisis. Yeah, I can totally see this. This is, um, I think, another manifestation of the lack of productivity since the global financial crisis. We've really gone nowhere.
Yeah.
The pre-GFC productivity trend, if it had continued, would mean that the UK economy is literally 30 to 35% bigger if we had maintained that trend. I mean, therein, in just one statistic, is the UK's problem. Can you imagine the
Yeah.
amount of tax revenue? Well, not all the problems, but so many problems would disappear if that previous trend had been able to continue. So that's the issue we really have to solve, is productivity. Is that a regulatory burden? Is that controls on the finance sector? I think you've highlighted in the past, the difficulty that banks have in lending to small businesses. Um,
Yeah.
you know, we've got to release that brake, because that's where real growth and wealth comes from.
Yeah. I mean, I think I was convinced by the analysis that said it was due to the increased capital requirements following the GFC, reducing
Mm,
bank lending to small businesses. I mean, who lends to small businesses now? Private equity, they're demanding like 30 odd percent of guaranteed returns.
mm.
Very, very difficult to get funding for small businesses in the UK.
This was an extraordinary chart. So it's not just in electricity prices that the UK leads the world, and our waste disposal costs as well, where we can see the standard rate here has zoomed up from, well, what is that, about £10 per tonne to £130 per tonne. So using landfill is expensive. So, how much tax is raised from this new higher rate of landfill tax? Well, less and less. So, is this a good thing because we're using landfill less? Well, possibly not. People are disposing of their waste possibly by fly tipping. We can
Yeah,
see an increase there. So, I mean, I think we need to see not just number of incidents, we need to see tonnage, don't we, to see if it makes up the
true.
difference, or
Yeah,
whether it's recycling and reduction in use in the first place.
but you do see a lot of fly tipping where I am. People just dumping sofas on the pavement.
Yeah, yeah. People do respond to incentives. So this is landfill tax rates across different European countries, where we are very much the highest. If you want less of something, tax it. So we want less landfill for good reasons. So high taxes, but there's a spillover effect via, possibly people fly tipping.
Yeah. So, I mean, the thing is, you need to, make lots of rules, but we need to enforce them. And we need to,
Ah,
like,
yeah.
enforce the law, and actually arrest people for fly tipping. More on that.
So UK in summary, the February GDP numbers were nicely to the upside, plus 0.5%. So year on year, plus 1%, still obviously pretty weak. Industrial production, surprising resilience, plus 0.5% month on month. Construction sector still struggling, and job openings continuing to decline. So, but I think the big picture is, there's no real energy momentum. We're passing small differences here, aren't we? But
Yeah.
basically, it's a flat picture.
Yeah. Now, Stuart, quiz of the week on fly
Right.
tipping. Okay. So in 2024-25, there were 1.3 million instances of fly tipping in the UK, as reported, and those were the only the ones reported to the police local authority or local authorities. So, how many people were sent to prison in that year for fly tipping?
Right. Okay. So these are the number of reports. So that has to be discounted by the number of people who were actually caught. So say 1% were caught. So we're now at 12,000, and say 1% of the 1% were then sent to jail, though that seems a bit high. So, what does that get me down to? Like 126 people, 1% of 1%.
I like your analysis, mate. You're just a factor of 10 too high. So the answer is 13. They did
13 people,
prosecute
right?
1,377 people. So actually, your analysis is 1%, is less than 1%. It's just your factor of 10. So it's like it should have been like 0.1% of incidents are
Right.
prosecuted. But then you have a 99.1% conviction rate. But
Right, but people are convicted, but they just get a fine.
a slap
Um,
on the wrist,
yeah.
community order, you know.
Oh, just even wow. So even community service orders, which
Yeah, I
yeah,
know.
well, yeah.
And
Mm.
frankly, I looked at the levels of the fines. The fines were generally de minimis, 250 quid, you know, basically. So compared to what somebody is legally using paying the landfill tax, the fines were just nowhere near enough to disincentivize it.
That's depressing, isn't it?
Yeah, right. On that note, onto the EU. So we had not much data in the EU this week. We had PPI numbers for February, which are basically going to be out of date, but showed that input prices were falling before the war. Retail sales for March, disappointing, down 0.2% month on month, 1.7% year on year, i.e., not much going on. Industrial production in February, i.e., still before the war. Numbers were revised up, but you know, really not going anywhere, down 0.6% year on year. Higher electricity costs in Europe are a drag on industrial production, as is increasing competition from China. Construction PMI, poor. Actually, over the last 3 years, according to this, the European construction sector has never been in expansion. Great. German Indeed job postings continuing to drift down. So, labor market in Europe showing no sign of strength. France, the same.
Keith, a quick story. I'm sorry to interrupt,
Go on.
but French job openings. I was reading a story about is it Dassault, the people who make the Raphael fighter? Is that the
Yeah.
name of the company? So, given everything that's happening in the Middle East and increases to defense budgets around the world and increased nervousness about buying American, lots of people want to buy Raphael jets. Are they going to make any more? No. Why not? They don't want to employ anyone because they won't be able to let them go if demand turns cyclical and goes away again. So they're
Yeah.
not increasing production because of the counterproductive effects of regulations to protect jobs.
Yeah. No, absolutely. When the UK Labour government talks about strengthening workers' rights, what they're doing is disincentivizing companies from taking people on. Hence, we've got this structural higher unemployment for young people. You know, higher job protection is good for people in work and bad for people trying to get a job. So this is Eurozone inflation forecast and forecast to rise above 3% on higher energy prices and knock-on effects by mid-year. Not good. So, quick summary, Eurozone economy really not doing much, frankly. Stagnation turning to stagflation. On to the US, Stuart.
Right. So CPI month on month, 0.9%, which was bang on expectations. So year on year, 3.3%. This is overall CPI.
Yeah.
So core CPI, 2.6% year on year in March. So not too bad, ex food and energy. CPI select categories here. We can see energy costs are big contributors to the increase in inflation. There it is, way at the top: fuel, oil, gasoline, all types, and airfares. Inflation swaps are forecasting that US inflation will peak around 3.5% mid-year, which I guess you would take, wouldn't you? Not too bad given the
Yeah.
impacts.
Well, given it's risen to 3.3% in March, they're saying it's not going to rise much more.
Mm. Yeah, so second round effects implicitly are not
Yeah.
being expected. Yeah.
Yeah.
Oh, goodness, that's what the next chart is, right?
Yes.
Cool. Right. Well, there we are. We've got it. Yeah. US health insurance price index. Mike, this is coming off, is it? I've just assumed that health insurance is always bottom left to top right, but
Yeah, well, I think everyone does, but this is the CPI Health Insurance Price Index, and it just looks total nonsense.
so my goodness, so this is saying roughly back to 2018 levels.
Yeah,
Seems impossible, doesn't it?
it
Yeah.
does seem absolutely impossible.
Hmm.
Yeah.
Tariffs have definitely had an impact on domestic and imported goods. So, how is this being calculated? Um, so basically, that a pre-tariff price trend has been reversed. Is that's the argument?
Yeah.
Is it?
So it
Yeah.
previously, goods prices tend to continually fall because of
Yeah.
increased productivity, and now it's reversed that.
Mm. So US PPI month on month in March, 0.5%, not not meeting expectations at all. So that was good,
Yeah.
which means that year on year PPI inflation is only 4%.
Now, we think there's about a 1 month lag between input prices and output prices. So that implies that the inflationary impulse is not as big as anyone expected.
Hmm. And core PPI was also below expectations. So even excluding energy, 3.8% year on year in March against expectations of 4.1. So GDP growth quarter on quarter annualized for Q4 revised down from, or expectations had been for zero point 0.7. It came in the end at just 0.5%.
Yeah. So government shutdown, basically,
Yeah. Okay.
distorting the numbers.
Personal income month on month. Oh, yeah. Well, this is February data, but down by 0.1% after a string of perfectly decent positive numbers.
But, we've talked many times about how, the US economy seems geared to the stock market. And, the cause of the drop was a decline in dividend income. Further evidence of that.
Personal spending month on month, however, was not affected, up by 0.5% month on month in February. So the savings rate, yeah, that's obviously what's taking the strain. That if spending is still barreling along, but income is not, therefore personal savings must be being squeezed, and that's what the numbers here show. A very small buffer in terms of personal savings rate at just 4%. Non-farm payrolls, well, these numbers are so heavily revised, as Keith mentioned. For what it's worth, 178,000 in March, but I thought this data series was revised massively, wasn't it?
Yeah.
So in a way, the month-on-month numbers are very difficult to extract much signal from.
And, you do fear that having fired a load of people from the Bureau of Statistics, the quality of the numbers is just going down. Just visually, it would appear the volatility has really increased.
So according to those non-farm payrolls, the US continues to add construction jobs, which, well, I suppose, yeah, this is data centers, isn't it? The household survey showed a loss of, yeah, okay, by contrast, that there was the household survey, and that showed a loss of 64,000 jobs in March. Non-farm payrolls year to date is plus 250,000. The household survey is minus 1.4 million. I mean, so
Yeah.
goodness, yeah, yeah. So we're awaiting the quarterly census of employment and wages to try to get some more high quality data on this.
Yeah. But you see that the quarterly census has tended to be more pessimistic
Mm.
than non-farm payrolls.
So in the past 2 years, all net job growth in the US has been in healthcare and social assistance. My goodness. I mean,
Yeah.
that's a remorseless trend, isn't it? Bottom left to top right.
Aging population in one chart.
Mm,
Not great for productivity, I'd say.
true. Average earnings month on month point up 0.2% in March, which makes 3.5% year on year, a bit below expectations. So less inflation pressure coming from that. US wage growth turns more K-shaped, right? So Yeah, my goodness, that's an acceleration of the trend, isn't it? Where the highly paid are being experiencing the biggest salary increases. That's taken off
Yeah,
during 2026, isn't it?
it has.
Mm. Average weekly hours worked, sort of plateauing, isn't it, really?
Yeah, but weak.
Mm. You are the labour force participation rate. That's a very weak statistic, isn't it? That's completely rolled over after bouncing back after COVID, down to 61.9. Mm.
So I think you'd say that there are lots of discouraged workers who are leaving the labour force.
Yeah. The unemployment rate hasn't really reflected this, as you say, they've left the workforce, 4.3%, but the U6 unemployment rate at 8%.
Yeah. So this includes discouraged workers.
Mm. Industrial production fell in March and was barely up year on year by 0.7%.
Yeah, so all the tariffs have not really resulted in recovery in US manufacturing.
Yeah, I mean, presumably the lags in anything like that have got to be so long. You'd have to believe the tariffs are going to be there for ages.
Yeah.
The lead time on setting up a factory must be enormous. Durable goods orders continue a weak trend. That doesn't look very attractive, does it? Over the past year, really has been flat to negative. Factory orders month on month, yeah, again flat as a pancake. ISM services PMI, well, actually not too bad on an absolute number basis at
Mm,
54, having come off a bit from 56 in February. Logistics managers index, well, that's looking very
yeah,
strong. So lots of
it
goods
is.
being moved around. Okay.
Yeah.
Hmm.
That suggests some sort of recovery in, goods purchases in the US.
Hmm. Total light vehicle sales, bounced back reasonably strongly, 16.3 million in March against expectations of just 15 million. Yeah, this US Michigan Consumer Sentiment Indicator, this has received a lot of attention, hasn't it?
Yeah,
This,
it
I think,
has.
is the lowest level almost since
Ever.
records began. It's
Yeah.
very, very weak. I suspect it's increasingly partisan and reflective of just general disillusionment and frustration.
Yeah.
54% of University of Michigan survey respondents stated that their financial condition had deteriorated over the past year. Okay, which is a
Yeah.
record high. And this certainly does not average out at 50, does it? This is over a
Yeah.
long period of time, it's actually been very low.
Yeah. So, I mean, despite the stock market, off to the races, this is a income inequality story. People at the
Mm.
bottom without assets are really struggling.
1 year consumer, is this for inflation expectations?
Yes. Yeah, it is.
4.8%. So people expect inflation coming soon. The 5 year consumer inflation expectation, I don't know how I would answer this myself, to be honest. I'm a little skeptical of the data, but I suppose the point is that it's ticked up a bit to 3.4%. Economic optimism index, yeah, also taken a big kicking down to
Yes.
42.8.
So this is a consumer survey. And again,
Mm.
it's less pessimistic than the University of Michigan, but they tell a consistent story.
Existing home sales, well, it's the same story, isn't it? For the past 3 years, they've been at very low levels. Initial jobless claims, yeah, so not too bad actually on this measure of the
Yeah.
state of the labour market.
As we've discussed in previous episodes, basically nobody's getting laid off and nobody's hiring. It's basically a
Mm.
sclerotic labour market.
Yes, because the continuing jobless claims in this picture is not too bad. It's bounced up a bit on the month, but it's not, the trend isn't
Yeah.
in the wrong direction.
Well, the trouble is, Stuart, that in the US you can only claim unemployment benefit for I think was it 6 months, and then you fall
Ah,
back to the stats. So it's not a great measure, to be honest.
indeed, jobs postings, it actually looks quite European, doesn't it? That's still
Yeah,
link up job postings are falling again. That one on the left is that's taken a real kicking, hasn't it?
it
That's
has. Yeah.
okay. The weekly GDP growth forecast estimates, the US, sorry, the Dallas Fed 2%, Atlanta 1.3%. So that's been a
Yeah.
bit weaker. That's
No,
trending
that's
down.
interesting because the stock market is absolutely off to the races, but
Hmm.
quietly, the GDP nows have been falling.
Hmm. The New York Fed 2.3%.
Actually, this one is the one we like most, and I'd say that's been broadly stable.
It has, hasn't it? St. Louis Fed 2%.
Yeah. So, the US economy still growing. I'd
Okay.
say
Yeah.
of, of all the four of those, basically the bottom line is, you know, not huge. Definitely the GDP growth weaker than last year.
The daily economic index. God, we're really getting micro, aren't we? So not too bad on this leading index. That would
Yeah.
seem to be gently optimistic.
Yeah, I agree.
US trueflation. Do we have a bit more faith in this one?
We
Uh,
do actually. And it's saying that, really US inflation, there hasn't been any follow through and inflation is up, but it's still weak.
cheap US natural gas is obviously a big advantage for the US and therefore US industry and therefore the US economy. So this is all geology, isn't it? The fact that
Yeah.
they've got the gas, not enough pipelines and liquefaction facilities exist, so it can't be exported. So if you need it, the US is the place to be. And I think some German companies have moved there specifically for that reason, haven't they? Lower immigration means that US labor force growth has collapsed. Yes, quite. And if GDP is, a function of labor and
Yeah.
productivity, half of that is in hiding or has gone back.
Yes, no, absolutely.
In 2025, net US immigration was minus 548,000. Wow. Right.
Exactly. Yeah.
Which means that the break-even pace of employment growth may now be zero. Right, so population is flat, so employment growth can basically be flat. Federal government civilian jobs. Wow, wow, that is a big step change down, isn't it? Right.
Yeah.
So the US is following in the UK in hollowing out the civil service to pay for welfare, defence, and social services. Hmm,
Because the thing is, they're still running a massive deficit. So what are they
they
paying?
are.
What are they keeping? They're keeping, welfare, defense, social services, and interest payments.
Right. So I'm just looking at the absolute numbers here. We're going from 3 million to 2.65 million. So basically a bit over 10% cut in the
Yeah.
federal workforce. Potential power shortage for AI infrastructure. Yes. Well, this is, I think, has been well covered in the press, hasn't it? That the data
Mm.
centers, one of their big constraints is power. So in some cases, they're building their own power stations.
Yeah.
In other cases, they're contracting for huge power supplies that probably they don't really need, but to try to get some growth in the power supply, and that's having a political impact with the local population not wanting to pay for the infrastructure that the AI companies benefit from. US's AI ambitions rely on foreign imports of major electrical equipment. Well, my goodness, this is true with turbines, isn't it? There's
Mm.
very few manufacturers of gas turbines, and they don't want to increase their capacity because there's a huge capital commitment for something which is likely to be cyclical.
Yes.
Right. So up to 50% of AI data center investments are expected to be delayed due to component shortages. There we go. The huge US fiscal deficit is a choice, but one that will be difficult to undo without. Well, this is your point that you were making before, isn't it? That it's such a huge deficit that getting it under control via tax increases, more debt, you're painted into a corner. Any choice you make is going to have awful consequences. And in an economy which is so financialized, so linked to the performance of the S&P 500, you're
Mm.
really, it's almost like you've got a single point of failure and the whole thing could cascade in a horrible
Yeah.
way.
Well, I mean, I thought this was an absolutely astonishing chart. Actually, I realized that it ends in 2023. I will update it for next episode. But, the growth in the corporate profits compared to corporate tax payments is astonishing. That is a societal choice to keep your corporate tax rates, well, to cut corporate tax rates so that their tax burden has actually been, you know, stable, whereas their profits have been going up, so their net tax rates collapsed. Yeah.
Yeah, it's extraordinary, isn't it? There are more and more evidence of almost sort of being an oligarchy and you run for the benefit of an already rich elite class. I mean, you're
Mm,
just asking for, well, I would say a revolution, but it's America. America doesn't do that. But
yeah.
God,
Well,
the frustration, the resentment, the anger, it's coming out bizarrely in voting for Trump, who is, in a sense, a representative of that class.
I know. It's absolutely amazing that.
Right. Trump wants to boost US defense spending from 1 trillion to 1.5 trillion. Keith, I think latest news 2 trillion. I want 2.5 trillion. It'll
Yeah.
keep changing. Um,
That's true, but where's the pressure, Stuart? The
yeah,
pressure
it's
is
all
all
up.
on,
Yeah.
up. You know, the same in the UK. And
Yes.
more on that next week.
Right. Well, here you go, Keith. I mean, this is what you're talking about, isn't it? The US government interest expense as a share of revenues. It's already, I think, interest is already larger than the defense budget, isn't it? And the
Yeah,
noose can only get tighter as more debt is issued and possibly as interest rates increase. It's just, this
yeah,
is why people like Ray Dalio think that the cycle is nearing its crisis point and that there could be huge social consequences from this in terms of very fundamental changes to the tax system, the political system,
yeah.
that the cycle just seems to be reaching a crescendo.
Well, this is, I've been thinking about this all week, and we don't have time this week, but next week I hope to, no, 2 weeks time, I hope to do something on it. But essentially, how does this end? Either you have prudence and grinding austerity for many years, or you have, some sort of crisis, populist crisis. So, Trump decides to default on foreign holders of debt or something,
Mm,
inflation, you know. And my feeling, just on the UK, is that there is no appetite for prudence.
yeah, I agree. Yeah. Subprime stress is quietly rising. Yes. I mean, look at this chart. So this is loan delinquency as a
Yeah.
percentage of dollars outstanding. Uh, the peak during the GFC was 18%. That steadily eroded, took a step change down during the COVID-19 forbearance, but has been remorselessly increasing since 2021 and is now above 10%.
So what this tells me is there's a cycle, and we
Yeah.
are midway through the cycle, but that looks like another financial crisis coming down the pipe in some form or another in a few years' time.
So US in summary, that well, the short-term numbers are perfectly okay. Q4 GDP revised to just 0.5%. But I think all the GDP now forecasts are clustering around 2%. CPI inflation less than expected. Second round effects not particularly evident. Non-farm payrolls for March were surprisingly strong, though the data on this is so choppy. Earnings growth fell back to just 3.5%. So the current situation, setting aside these longer term disaster scenarios, the current situation is perfectly acceptable.
Yeah, I mean, the economy is resilient, the labor market is weak, but also growth is lower than it was last year.
Hmm.
Okay, thank you, Stuart. On to one chart, and this is the US egg price. And you remember, we had bird flu in the US, and the prices pentupled. Well, they're right back down again. And this is an example of the capital crisis, capital cycle. Frankly, high prices incentivize more production to come online, and in the case like eggs, actually, you don't need that much more capital to set up a chicken farm. If you've got a farmer, you just like existing sheds, get a few chickens in, and so you had a supply response. And This is the problem whenever you have, very high prices, and it depends on the speed of the capital cycle. Now, in the copper special, I will be editing and getting out this weekend, promise. Then it takes modern greenfield copper mines take 17 years from discovery to first production. And because they're getting deeper, it can take another decade before they hit peak production. So the capital cycle is really slow. But in the egg market, capital cycle is quite fast. And you see, egg prices come right back down again.
77 cents for a dozen eggs.
I
That is
know.
phenomenal. Looks
It
like an
is.
awful business to be in, doesn't it? I mean, look, there's no long-term price trend there, is there? That's
No.
terrible.
Yeah. Terrible. So we have once again overrun, but there are a couple of things I want to get through. First of all, Simon W's technical analysis. So, what's happening with the Nasdaq? And his analysis is that we have had displacement, i.e., so displacement is a breaking, massive break to an existing trend, so that the Nasdaq is breaking out essentially. Very bullish, he says. And the same is true of the S&P 500 displacement.
But
No.
this I find a very interesting example. Obviously, I'm no sort of technical trader, so during the drawdown in March and early April, how is that like a sell signal, and then it quickly whipsaws over the past week, being back to a buy signal? Is that what's happened?
I think yes, essentially. It was like you broke the previous trend, and um but I'm trying to remember that Simon's previous analyses, it was there were support lines that are not on this chart, and it was breaking down towards those support lines, and it is suddenly and very quickly reversed. And it's the speed of that reversal that Simon is saying is a displacement, and is super bullish, and is frankly very difficult to argue against that. And I think given the relative but given that how weak the good news is, i.e., the Straits of Hormuz remain closed, the speed with which the equity market is taken off, I mean, is astonishing. And frankly, I bought back in last week, put all my spare cash to work because I thought this market just wants to go up. So I concur.
Yeah.
And we have been relentlessly wrong about Nvidia. We're relentlessly thinking it's overvalued. Simon W is saying no, it's going to go up. He's right again. God damn it. He should be running this podcast, actually. Anyway, silver. Now, he is skeptical about silver. He thinks it's rallying for now, but in an overall downtrend. Whereas I've actually bought some for once. It having got, doubled in the past year. We'll see who's right. Gold, he thinks the rally's back on, rallied initially on dollar weakness. It's now establishing a new up channel. Once it breaks through 4,800, it will continue towards 5,000, he says, on the technicals. Copper, I found copper chart amazing. Rallying, but, has reached its previous resistance level at around $6 a pound. Previously, it's never been able to break through that. US dollar has reversed course following the ceasefire. Yeah, going nowhere, I'd say. This is the US 10-year in a channel, going nowhere. Upside resistance at 4.4%, downside support at 3.85, going nowhere. I asked him to look at the Japanese 10-year, and he said this is a macro issue. And, well, I would say it's trending relentlessly higher. At
Mm.
some stage, I have prepared this big section on whether we're going to have a Japanese fiscal crisis. And there's just been so much going on in the world. I haven't been able to record it for about 2 months now. But at some stage, when this calms down, we will do it. So, as ever, a huge thank you to Simon W for all that. Reminder, none of this is investment advice, but he's very bullish of equities. They're breaking out. Now, I'm going to rush through these because we're over time, but Viktor Orban was kicked out this week. So, what effect did he have on the Hungarian economy? You will know that he was a populist, illiberal Democrat. And when we see Democrat, he was very bad for our Hungarian democracy. So, this is the Liberal Democracy Human Freedom Index, essentially. And really declined in Hungary as he cracked down on the rule of law and independent media. So this is the World Bank Governance Indicator score. The blue line is Hungary, and this is accountability. So whether citizens have their voice heard and whether the government is held to account, and his seizure of state media. And he basically also arranged for newspapers to be controlled by cronies. So you didn't have the role of independent media was really undermined in Hungary. So you can see big deterioration in various measures of the strength of democracy. So rising corruption, he gave cronies, backhanders, etc., undermined the role of the police. The police became a function of the state. So, they enforce the law against dissidents, etc., just like in the Stasi, East Germany. And all of that had a very bad effect on the Hungarian economy. So when we talk about, in the US, how competition policy is not being enforced, etc., all of that is just bad for economic growth eventually. So Hungarian wages have lagged behind Polish wages. This is a percentage of German wages, not good. These peers are all the ex-Soviet bloc countries, essentially. So per capita GDP stagnated. Pre-Orban, it was growing okay. Actually, Orban came in 16 years ago, so that's not quite true, but it was doing okay. But it's no longer doing so relative to Poland, and it's had high inflation. It's also run really huge. These are big numbers. These are sort of US numbers, fiscal deficits. So all in all, corruption and the erosion of law are bad for an economy is all you need to know. And, voting in populists who are going to, in the case of Donald Trump, undermine the rule of law, enforcing the law against their political opponents, etc., etc. All that is bad for confidence and bad for the economy. Okay, and final section this week. We have talked about all the products which are being disrupted by the war. One thing we haven't talked about is tungsten. So, tungsten hexafluoride. So, chemical symbol for tungsten is W, by the way. So, WF6. Now, it turns out, I always think of tungsten as basically being mainly used in weapons and in, tungsten carbide drill bits. So, just used for its hardness. Actually, it's also a critical component in semiconductor manufacturing. So what you do is you use tungsten fluoride, which is a gas, for vapor deposition of tungsten in chips, and that provides strong electrical conductivity within the chip, and in particular 3D memory chips, where you have these stacked cells, you've got to do that 200 times. So you've got to do tungsten vapor deposition 200 times to produce the chip. So tungsten is a key component in semiconductor manufacturing, as well as being, an abrasive used in cutting tools and used in armor-piercing shells, etc., etc. So we talked about previously why the tungsten price is rising, and it's not due to the war, it's due to China. So in February 2025, China imposed an export licensing regime on strategic minerals, including tungsten, and tungsten prices went through the roof. So China is responsible to 83% of world tungsten supply. And what's been a kicker this year is in January, it added export controls on dual use items destined for Japan. Okay. That includes tungsten. Now, Japan produces around 25% of the world's supply of tungsten hexafluoride. So far, South Korea is unaffected. So, this is a map, pause if you're interested, showing where the main supplies of various elements come from. 63%, actually, China's responsible for huge amounts of these things. So tungsten, 83%. Gallium, 99% of gallium comes from China. And the effect of Chinese export restrictions is that tungsten prices have trebled over the past year. And these numbers are just till February, gone up further since then. And obviously, tungsten is dual use. It's used in armor-piercing bullets, etc. Now, I thought this was quite interesting. So this is from tungsten producer Almonte Industries, and the blue line is supply. The black bars are supply. The red lines are demand, and you can see that actually the market was in deficit, but it was forecast to go into surplus in the coming years. So short-term supply shortages, but nothing there that would indicate that the price of tungsten should go to the moon. That is a function of Chinese export restrictions. So there, because of those exports restrictions, Western countries are looking to get into their own independent sources. So you've got loads of projects all around the world starting up. In particular, Almonte Minerals have the largest tungsten mine in the Western Hemisphere, or so Western world. That's in South Korea. And Tungsten West are starting up the Hemadan mine in Devon. And that, again, is a huge resource, but one that has been uneconomic at previous tungsten prices. So short term, the tungsten market will remain tight as long as Chinese export controls remain in place. Now, is this a good investment idea? And I'm skeptical that it is, because China has an incentive to keep export controls in place as long as they're effective. And they're effective only as long as the West has a supply deficit. When the West no longer has a supply deficit, then keeping export restrictions in place has no effect, because the West has tungsten independence. At that point, the incentive for China would be to remove export restrictions, flood the market with cheap tungsten, and bankrupt all these new mines. So short term, tungsten price will be high, but I'm not sure medium term that it will remain high forever. And the problem is, when I look through this, that we are late, very, very late to this party. I'll take you through some possible tungsten investments. They've all gone absolutely to the moon. What's that? Almonte Industries. Still loss-making. Forward PE ratio of 40. And its shares were up tenfold. I think a bit late. EQ Resources has actual production from its tungsten mine in Australia, appropriately named Mount Carbine. PE ratio of -43. It's still losing money, but I mean, actually, the forward PE ratio at these prices is quite reasonable. And here we go, Tungsten West, aiming to reopen the Hemadan mine in Devon, fourth largest tungsten deposit in the world, fully permitted, existing infrastructure. It's a brownfield restart. because the previous operator went bust at lower tungsten prices. Now, but the shares have what? Gone up tenfold in the last year. Stuart, what do you think? Tungsten.
It's completely not my area of. It's exactly the sort of niche story where you need to have specialist knowledge that I'm absolutely trying not to be suckered into, or sucked into, I should say. I'm going to be doing nothing in this area, I can tell you.
Yeah, no, I just thought they'd gone up way too much. Needs to be in right at the start. Okay, we're going to wrap it up there. I produced loads of extra sections, which once again we are failing to get through. When Donald Trump actually calms down a bit and the world economy calms down, we can talk about other things. As it is, we're dominated by his misadventures in various parts of the globe. Okay, so finally, good news. This is actually really, I thought, very interesting, potentially important. So, Germany has done a survey of 1 million actual German solar installations and looked at the degradation in performance. And they think that everyone has been too conservative about degradation, i.e., they think that currently, when I had my solar installed, they say its performance will decline about 1% per year. Actually, it's less than that. The actual performance falls by between 0.5 and 0.6% per year. So, which is really good news. So that means your solar installation will stay good for longer and affects the economics of solar in a positive way. So, you know, talking about cheapest form of energy in hot countries or countries where the sun shines, solar is by far the cheapest form of energy. Concluding comments. Well, chaos continues, really. We're now basically dependent on Trump and Iran coming to some sort of agreement. If they don't come to some sort of agreement, then the Straits remain closed and supply chain train pressures keep on building to the point which would very much undermine this enormous rally in equity markets. Stuart, your thoughts?
I'm a bit more nervous than you. I think everything has gone so right for so long. Valuations are stretched. I think that there's a bit more chance than you do of a, a negative cascade with Iran and energy. All I'm doing in terms of my portfolio is nudging things more and more conservatively. So I am completely not with the zeitgeist of markets at the moment.
Yeah.
I'm more cautious.
Yeah, I mean the thing is, Stuart, since I've decided to just follow the market, things have gone better. So
Mm.
I'm going to be nimble, and um, but in my main portfolio where you have to pay CGT, being nimble is a very bad policy, frankly, because you every time you buy and sell, you're being charged 24% CGT. So in that case, I'll be slowly moving into just ETFs that I can hold forever. Anyway, thank you very much to Stuart Owen for dialing in from Tokyo, and thank you to you all for sticking with the podcast. And please, can you press like and subscribe to the channel? And it's goodbye from Stuart Owen.
And it's goodbye from Keith Jordan. Goodbye.
Goodbye.
Full disclaimer. The material and information contained in this podcast is for information and entertainment purposes only and should not be relied upon for making a business, legal or any other decision. We may own or have a financial interest in any securities mentioned. Listeners should conduct their own research or consult a professional investment advisor before making any decisions regarding topics mentioned on the show. Whilst we endeavour to ensure that the information presented on the show is correct, we make no representations or warranties of any kind, express or implied, with respect to the podcast and website or to any information, products, services or related graphics discussed or presented in the podcast or website. Any reliance you place on such material is strictly at your own risk. You are solely responsible for the investment decisions you make. We will not be responsible for any errors or omissions in the podcast or website, including in articles or postings, for hyperlinks embedded in messages, or for any results obtained from the use of such information. Nor will we be liable for any loss or damage, including consequential damages, if any, caused by a reader's reliance on any information provided by the podcast or website. Please do not listen to the podcast if you do not accept self-responsibility for your actions.